Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to be with you this day. If I can find my notes, I'm going to be just fine. I do want to thank you for listening to this show, making it one of the most popular shows on the Voice America Business Channel. We want to let you know and remind you that I am the editor of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that by going to calling 718-457-1426 or go to miningstocks.com. We'd like to remind you of chenpicks.com as a place to go to pick up Chen Lin's newsletter. What is Chen buying? What is Chen selling? Especially if you have an interest in the biotech sector. That's one of Chen's strengths, the energy sector as well as gold and the gold mining stocks too. We also like to remind you that Michael Oliver's website is olivermsa.com, olivermsa.com. You can go there to sign up for Michael's excellent work. And a mark of Michael's excellent work is the fact that he's with us almost every week. Whenever he's available and whenever I can get him, we have him here. So, and he'll be talking with us in just a moment or so. Before we get started with today's show, I would like to welcome Gatling Explorations as a new sponsor to the show. I'm very excited about adding this company to my newsletter, Recommendations, Jay Taylor's Gold, Energy, and Tech Stocks. Gatling has an excellent exploration team headed by Dale Ginn, and they are developing the Ladner project in Ontario that already has just a whisker under 1 million ounces, high-grade ounces, and it is my firm belief that this company is likely to expand that resource to several million ounces. And it is in the middle of an area where there are a lot of hungry mills that would love to have some high-grade ore feed. So this is one that I think is very much worth keeping an eye on. Of course, that's why I purchased the stock myself, why I have it in my newsletter, and sometime in the near future we'll be talking to their CEO about that company's prospects. Also, before we get started today, I want to mention that Radisson Mining, which has been a sponsor on this show a few weeks ago, announced a blockbuster drill hole today. It intersected 66.7 grams of gold over 4.7 meters, but more importantly, it was 300 meters beneath the company's current resource on its O'Brien mine in Quebec. Now, this intersection not only dramatically increases the implied high-grade ounces, but what it also provides is very good mining widths. You know, the width at which you have to mine something or close to 4 meters of width is good mining widths, means less dilution, but also there's a lot of disseminated lower grade gold mineralization around the vein structure. So it should be a very, very positive economics for this project. Of course, a lot of time and a lot of work remains to be able to take that to the bank, but it is looking very, very positive, and I'm really pleased to own this stock and to have it in my newsletter. Even though they aren't currently a sponsor, it's one I would suggest you might want to pick up a copy of my newsletter, read about it, because I'll certainly be writing about it this weekend. Aside from Gatling, our sponsors for this week's show, Novo Resources, Great Bear Resources, Irving Resources, and I'm looking for some really exciting news from in the near future from all of these sponsors. Novo Resources by the end of this week, or perhaps by the middle of November, from both its Egina projects and possibly from its Beaten Creeks project as well. Great Bear has a drill news flow almost nonstop, but last week I really found the news that the company is planning to dole out a 2% net smelter return to its shareholders as a hugely positive event, at least for the longer term. Very exciting development, in my view, for Great Bear. And Irving Resources should also be coming out with some, I expect, some high-grade assays. Of course, one never knows until the assays are reported from the lab. But that is looking very, very exciting as well. It's a Quinton Henning company. Newmont Mining is part of that, owns a big chunk of those shares, as does Sumitomo. So obviously the big boys see some big potential or they wouldn't be involved. The big companies don't get involved in small projects, so keep that in mind with this minuscule market cap company. I've titled today's show, How Do We Invest When Gold Goes Parabolic? David McElveny, Daniel McAdams, and Michael Oliver are return guests for this week. Well, once you realize how sick the existing fraudulent fiat global monetary system is and how vulnerable it is to total collapse, you begin to realize that gold is likely destined to rise exponentially in value as measured by an increasingly worthless fiat currency. When the dollar becomes worthless or approaches worthlessness, it's hard to say where the price of gold will go as measured in that increasingly worthless currency. Perhaps a less dollar doomsday scenario is more likely than something at end of the world scenario, in which we went through a couple of those experiences. At least I did as an older guy. I remember very vividly 1980 when gold rose that decade in the 70s from $35 to $850 by 2000, and then there's the 2000s when gold was in the early 2000s when it was around $250, went to $1,900. We could very well be witnessing something of that magnitude again. So we'll ask David McIlvaney to provide his ideas in either extreme case or something more moderate, like we've experienced in recent history. And indeed, it looks like we are in the early stages of a major bull market for precious metals. When it's over, it may very well be a great time to go back to the general stock market. But I think at this point in time, that looks probably the opposite is what you want to do. We'll be talking to Michael Oliver in a moment and get his latest thoughts on that topic. We don't often talk about foreign policy on this show, but of course it is very much related to the markets as the U.S. uses its power on the world stage to force its will on other nations. President Trump has been roundly criticized not only by Democrats but also by some of the Republicans for his recent decision to reduce America's influence in Syria. But will that hurt America economically? And we'll talk to Daniel McAdams to try to get his views on that and how likely it is that we actually will pull out of the Middle East or out of Syria. All those are speculations. What we really like to do is talk to Michael Oliver because he doesn't speculate, very much anyway. Michael basically looks at what the numbers are telling him. So welcome, Michael, and thank you very much for being with us again.
Hi, Jay. Good to be back.
Always good to have you with me. Every week, almost every week, whenever we can get you, as I tell my listeners, we're going to try to have you here with us because I value your insights so much. Michael, this morning when I asked you what you'd like to talk about today, you said, and I quote, MSA has long said that focusing on near-term data points and presumed new bullish economic realities does not offset a decade of central bank-caused upward pricing of stocks. What we have here is not a concrete and steel skyscraper, but a plaster and plywood construct. Could you be a bit more specific about that, what you're talking about? I gather you're talking about a stock market that you think is very shaky. Do I have that right?
Right. It's technically we have numbers below the market, not far below the kind of numbers that you would get in a mild correction. You know, people think 5-10% to corrective type thing. We argue if you do that, you get a collapse. We've got structures below the market on momentum, not clear on price, but very clear on momentum. That if you have that type of correction, it will not be a correction. It will morph into something more dramatic. The question, though, is a lot of the data points of the last few years have gotten better. The type of stuff that people focus on, you know, the GDP and the whatever metric you want, earnings and so forth. And they're certainly better than they were over the last 10 years. But you've got to factor in the issue of pricing. If the S&P were where it was 10 years ago, let's say 13, 14, 1500, it had not risen artificially by central bank promotion of the stock market, because when they created the liquidity, they wanted it to go into stocks. Bernanke stated it overtly. That's what his intention was, to create a good sentiment out there. In fact, the investors, their preference was to put it into stocks. But then again, that's when the S&P was coming up off of a low in the 600s, in the 1100s in 2011, 2012, 1300 at the Bin Laden high. And so that's a different price level than where we are now. So everything between, let's say, 1100 and where we are now was largely created by central banks. Now at the top, as we're topping out, in fact, if you look at the S&P and most indexes, go back almost 2 years to January of 2018, you see mostly lateral action. There's repeated teasing new price highs, but really they're not significant. We're 4 or 5% above, about 4% above where the S&P was in January 2018. It's almost 2 years. That's hardly. Sugar's up 18% in that period. Anyway, the problem is that the structure below the market, if you look at an S&P price chart, it looks like a skyscraper. We argue that most of that skyscraper was not built by legitimate market demand based on real fundamentals. It was based on central bank stimulus, liquidity that the investors did put to work in that area. They over-put it to work. That's the problem. Most markets peak with excessive pricing. They go too far. That's sort of normal in markets, especially the stock market. It's driven largely by sentiment. And once they overstep what should have been a normal high, and they create a blow-off or an excessive high, especially one based on the factors we've had in play, that market's in trouble. I don't care if there's good news at the top or not. That's delusionary, because what's below you is the issue. The 2,000 points of S&P pricing of the last decade that was based on nothing but liquidity. Now, there's a lot of evidence, technically you can see it, that investors are moving out of the stock market and into other arenas. One piece of evidence we're about to get in 2 days, the end of the month, is closed by the Bloomberg Commodity Index, which by our metrics is a major breakout, assuming it could just hang around where it is now. That is evidence that money is moving into the commodity category, and it should, because that category is priced out. It collapsed in 2016, had a recovery through 2018, but not all that much, pulled back to test its lows the last 6 months, held, and is turning up again. So it's really been more or less lateral for about 3 or more years. So it's proven it doesn't want to go down anymore. The issue is, when does it go up, and we see numbers that it's crossing this month that indicate it wants to have that launch. That will surprise most people. It will induce further investment flows out of stocks into commodities and commodity-related stocks. And that should be a shock for a lot of market participants, both in the bond market, who don't expect inflation, especially commodity price inflation, and in the stock market. So we think those pieces of evidence are occurring. We're also watching the dollar index, because it's been asleep for 14 months. You can draw a line back to August of 2018 and just draw it right across, and that's where we are now. It had about a 3% range. It's been very quiet, but steady. Gold didn't care about the steady dollar. It went up anyway. If the dollar's about to break down, and we're toying with numbers right now that it could signal that, then you've got two dormant markets that are waking up.
Yeah, big ones.
Investor preference flows.
Big ones. Big, important ones. They've been asleep. So just in summing up here, it seems to me what you're saying is it's as if we were standing on the upper decks of the Empire State Building, but instead of steel and instead of steel and cement underneath us, we have what, bamboo, and what did you say it's built on?
Plaster and plywood, not bamboo. Bamboo's pretty durable.
Well, that's true. It is. Yeah, but I don't know. It's still a bamboo that far above
anyway,
the earth.
We're not standing on a concrete structure. You're standing on plaster and plywood.
Yeah, and the important thing is that a couple of these other markets that you feel are so key to seeing gold take off, the dollar and the commodities markets look like they're very close to a turn potentially, huh?
Yes, the Bloomberg is already at levels that if it can just hang around through Thursday's close, it will achieve it. The dollar index, if it slips just a little bit, will break below its level. So it's interesting that those two have maneuvered to their starting gates, one being a downside starting gate, the other being an upside gate. We think when those two engage, and even if just one engages the Bloomberg, that will have a shock effect and definitely be wind at the back of the gold market, because gold's done all it's done over the last year without any commodity inflation.
Yeah, that's true. That's true. All right, Michael, we'll have to let it go at that. Very, very interesting thoughts on this whole on these markets and how they're interrelated. I really appreciate those insights. Very important. Thank you so much for being with us, and we'll look to do it again next week.